if you take a look on B courses right now, um, I've been doing a little bit of catch up the last couple of days, um, yesterday and today, dealing with some of the stuff from chapters primarily 6 and 10. Um, if you take a look, you can see that the chapter 6 homework is up there. I've got that published up there now. And the chapter 10 homework is there as well under chapter 10. Relating to chapter 6, the lecture for chapter 6 is there, and I think I hadn't put the lecture, the end part for chapter 5 up there yet. So those lectures now are caught up for chapters 5 and 6. 10, I'll put up today, or tomorrow, I guess, along with the rest of today's discussion that as we speak is being recorded. So I'll put those up, and you'll have all those in preparation of the midterm, which will be on Tuesday. Okay, so what we'll do today is definitely finish chapter 10, and we'll see where we stand at that point. We may go ahead and start to look at the practice midterm that is sitting under the heading practice midterm / final under that module there. So you can see practice for midterm 2 is there. I don't know if we'll get started on it today or not. The game plan will be to definitely do it tomorrow for our discussion time, right? Which goes from 11 to 12:30, right? And I put quite a few questions in there. I was a little heavy on the interest side, just because we didn't get enough coverage of it in the chapter 10 homework. So I put a few more questions just so that we get some. When I say a few more, I put 15. The exam's going to be 15 questions, right? We're on the same page with that now? Okay, so the exam's going to be 15 pages. I mean, 15 questions. If I put one question on each page, that wouldn't be bad. Okay, it'll be 15 questions and one free response. Okay, just like we did last time. And in the practice midterm, I put 2 free responses just so we have a little more practice with those. Okay, so that'll be tomorrow from 11 to 12:30. I will record that, so if you've got some other commitment that you're used to on discussion day, I'll record that and I'll post it up. I guess tomorrow, so that it gets there. If you guys are thinking, that I go home and I sleep on the couch, in between, well, I do sleep on the couch, but it's in between trying to rush from one thing to the next. So Saturday I have CPA review courses that I have to teach, so it's kind of hard for me to get something done that very same day or that next day, but I'll try to do it. If not, latest it'll be up by Sunday. The practice midterm lecture I'll have up by Sunday. Okay. All right, guys. So let's go ahead with all that and not waste any more time and jump ourselves into the balance of the chapter 10 material, which I'm pretty sure we had stopped at charitable contributions. Okay, so let me get to that. Charitable contribution is kind of an interesting area in that it looks like it's really complex with a lot of different categories for what you can deduct, what you can't, limitations on what you can deduct and what you can't. But it's one of those things that after you kind of stare at it a couple times, it's not that difficult to kind of get that into your head a little bit. Okay, so let's go ahead and one more thing about the exam. You can pretty much bring anything. Just bring whatever. Okay, I mean, don't bring the printout of the whole test bank, because I give you like all those test bank questions. I wouldn't do that. But if you want to bring your quizzes that we've had, if you want to bring your slides, if you want to bring the textbook, you want to bring your notes, I'm going to be very liberal as to what you can bring. But don't embarrass us by coming in, like this and say, okay, I got the whole test bank here, and I'm just going to look up the questions. I don't want that, But other than that, you can pretty much bring. And I let you bring the quiz questions because I'm not going to give you the same questions, I don't think. but at least you can, by analogy, sometimes you learn by those, right? And so you can, by analogy, figure out what's going on with the other ones. Okay. And then give me a sense. Do you guys want to do this thing tomorrow? I could always record it from home because I'm getting all these empty seats. I don't know if anyone thinks it's worthwhile even hearing me talk about this stuff. So, if you want to save me the hassle of coming over here, I won't cry if I sit at home. So let me know if that's a feeling that the class is having at this point. Okay. All right. Charitable contributions. Okay. And what happens is they will allow for charitable contributions, but it has to be they'll let you take an item. Remember, we're in itemized deductions now. They'll let you take an itemized deduction, but it has to be to qualified domestic organizations. And we're going to see that they're going to have different categories for these qualified domestic organizations that they'll allow us to take our charitable contributions for. Okay. Now, when there's a contribution, there must be donative intent. Okay. When people give money to these not-for-profit organizations that are qualified for charitable contributions, there's going to be an expectation that the individual is doing that without, thinking, okay, I'm going to get something back from that. So we'll see, for example, if you give money to a trade organization, what they call a 501, IRS code 501c6 organization like the AICPA, they're not going to let you deduct that because they're thinking, well, you're a CPA and you're giving to the AICPA because you are expecting you're going to get something back from them. It has to be what they call 501c3 organizations. Those organizations that are trying to help, the public, and the donor is not sitting there expecting that somehow they'll get something back in return. So it has to have donative intent. Okay. Now, the contributor cannot receive something back then that is of value, that has a fair market value. Okay. So if they do, that's going to reduce the amount of the charitable donation. Okay. So let's say I go to one of these. You guys ever been to one of these silent auctions? Ever been to a silent auction? Silent auction is you sit there and you write down what you want to pay for something. Let's say they have a couple of Oakland A's tickets. I like the A's. So I sit there and I start bidding on these tickets, and maybe other A's fans are there, maybe people I know. We're all having fun trying to bid up these Oakland A's tickets. And let's say the tickets, there's two of them worth $50 each. And we bid them up to $175. Well, we're getting something back of value, right? Two tickets worth, what, $50, $100? So the contribution in that case, assuming it was a, organization that was eligible for a charitable contribution, is going to be $75, right? The tickets were only worth $100, and we bought them for $175, so that would be the amount of the donation. And that's sort of the same thing here. I guess Ralph is going to the symphony instead of a baseball game, but it would work out the same way. Okay? All right, so you come over and you take a look at contributed, exception to the tangible benefit rule here. Okay, what happens? Let's say that I go ahead and I give a contribution to, say, the university, and that contribution, say $10,000, whatever, gives me the right to buy 50-yard line tickets to the football games. Well, you're looking at that and you're saying, well, is that really a contribution, or did you get something of value of that? So the way the tax law solves that one is they will let you take a deduction to that, but only 80% of that deduction would be allowable because you did get something back, right? The right to buy those tickets. So they'll let you take an 80% deduction for that. So let's just look at this Janet, and she donates $5,000, and the payment guarantees that she will have preferred sitting, 50-yard line for football games. Okay. Subsequently, Janet buys four $50 game tickets. Under the exception of benefit rules, she is only allowed what? A $4,000 deduction. That's the 5,000 times the what? 80% limitation, because that gave her the right to buy the tickets. Okay. Now, if she also got the tickets as part of her donation, then we would have to limit it even more, right? Which would take it to 4,800. So if Janet's 5,000 donation includes the tickets, now she got what? Now she gets the 4,800 because it's the 5,000 less the $200 for the tickets. They are treated as separate amounts. Okay, so now her charitable donation would be what? Would be 80% of the 4,800 if they gave her the tickets. Okay, but 80% limitation if it gives you the right to buy tickets for a certain price. Okay, and then you go and you just buy those tickets. And of course, the cost of the tickets is never a charitable donation because you're getting what? You're getting the right to watch the game, whatever, and that would have its fair market value of, in this case, the $50. Okay. All right. Let's take a look at things that there will not be deductions for, and basically, it's your time. Okay. The cost of services that you provide to a not-for-profit are not deductible. Okay, so you can't sit there and say, I'm going to be involved in the voluntary income tax assistance program, these VITA programs, and I'm a CPA and I'm making big money doing taxes, so I'm going to go ahead and deduct $200 an hour for my time filling out those tax returns for the VITA program. That's not allowable. Okay, they're not going to let you deduct your time. What would happen? Movie stars would be appearing all over the place, right? Saying, "Oh, I'm helping out this charity," and then deducting their time for that, right? And they make big money. That's can probably wipe out their whole salary, their whole tax liability just by appearing some different places and just showing up. So your time is not deductible. Okay, the cost of services. Now, you come over and you have these out-of-pocket transportation costs. If you had to get there, that's deductible. Or let's say I was involved one time with a volunteer income tax program in which we went to the Mission District and provided VITA services to Latinos, and they were providing, it was a Hispanic CPA organization I was involved with, and they were also helping to close the language gap on some of that stuff, because sometimes English second language, hard to figure out a tax return, so we were trying to do both things, go to, a certain part of the Mission District that didn't have as much income, and we were trying to show them how to use the earned income tax credit, and we're also providing the language service as well. Well, let's say, you were trying to do something, and the one that I was thinking about, maybe traveling to rural areas where there's need for help. Indian reservations. If you've ever visited an Indian reservation, sometimes they're in pretty difficult situations. I went to Indian reservation one time with GAO where we were looking at how they were providing funding. And they were pretty upset with us, and they were talking about what your government has done. Your government's done this, done that. And I kind of sat there and said, well, I'm Puerto Rican. I don't know about your government, but I didn't say that. But anyway, pretty tough times. Colonials, right on the border between Mexico and the U.S. I mean, pretty difficult areas, right? So I'm thinking that, maybe a good voluntary income tax program would be to go to those areas, help them fill out their tax return, help them get the earned income tax credit. I think a lot of those individuals would benefit from something like that. Okay, so if you have to travel, long way of getting to the point here, if you have to travel to provide some sort of service, you can deduct amounts for lodging, the cost of meals while away. We've already seen the transportation cost. Okay, so if you travel, you're coming out of pocket to do this volunteer work, they'll let you deduct your, out-of-pocket costs. No deduction for your time, though. Okay. All right, good. Other non-deductible items, dues, fees that you pay, even if it's a not-for-profit organization, you pay your dues to belong to that, that is not deductible. You can't deduct your tuition. You can't sit there and say, well, wait a minute, UC Berkeley is a recognized charitable organization, and I did pay my tuition, so let me deduct that. That is not going to work, guys. That's what you're getting something of value back. You're getting the education, right? Okay, the degree, etc. Okay, value of blood given to the blood bank. Okay, can't deduct that. So some of these things are almost comical, but they're pretty obvious things that you can't deduct. Okay. Okay, good. Now, to be a qualified organization, it has to be a domestic, non-for-profit organization of the U.S. And this publication 78 lists a lot of the organizations. That does not mean that if the organization is not listed, that you can't deduct it. And so it would really, have to meet the requirements that we've been talking about here. Fair market value, whatever the fair market value of that is. So you're talking like what, you give property or something? Yeah, like let's say you give a bunch of old clothes to the Salvation Army or something. Okay, and we're going to use some examples with clothes here in a minute. And every time I think of these clothes examples, I look at my closet, which has, stuff I can't wear anymore, and I should think to myself, I should go do that. Okay, so what happens? If you take those clothes, then you would be able to deduct the fair market value of that clothing with certain limitations. Okay, we'll see what some of those limitations are, but it's typically fair market value. We're going to see that if you donate some certain items, basically items that don't qualify for fair market value, then it'll be whatever your basis in that is. Okay, so we'll see how that works, but they'll give us some. We'll have a lot of examples with that. Okay. Okay, so let's take a look at qualified organizations, publication 78. Record keeping, okay, they expect you to have the appropriate documentation. So let's just go with the clothes example. Do you just go and throw your clothes on the porch of the Salvation Army and take off? No, you're going to ask them for a little card that what? Will approximate the fair market value. Now, hopefully the IRS isn't listening, but I'm sure they know this, which is what? They just hand you the card. And you, fair market value, $10 million. Okay, that's not going to fly because, IRS is going to know that you didn't donate $10 million worth of clothing. That's going to be a little tougher for you to prove. But, you can put down an amount that seems reasonable and won't get the IRS up on you, and that's your documentation. Okay? And they do this for certain areas where special rules may apply. I guess for automobiles, there must have been some abuses, and there must be something out there where IRS gives specific documentation requirements for the fair market of vehicles. You guys, I don't know if you guys listen to the radio as much as I do, but I always get that cars for kids commercial all the time. Okay, this is the thing that that they're sitting there and probably saying, okay, yeah, we've seen some abuses, so there's specific documentation. And an organization that specializes in getting those kind of donations probably knows what the documentation requirements are and likely going to, hand you whatever it is that you need to satisfy that. Okay? Okay, good. Let's take a look then at the types of property. And this is where we're going to get into when you're donating property. It depends what category it falls into as to how you can take that deduction. So if it is ordinary income property, okay, that's basically what? Items that are going to produce ordinary income or short-term capital gain if sold. If it's ordinary income, then they're basically going to limit your deduction to the lower of the adjusted basis or the fair market value, whichever is lower, and it ends up being therefore that they're going to basically have you take your basis. You're not going to be able to take the fair market value. Okay, so just look at this one. Tim donates stock to this university, and he purchased the stock for $2,500. Now that's his basis, right? He purchased it for $2,500 on March 3rd. In March 3rd, 2017, is that a year or less than a year from May 1st, 2017? Okay, so he didn't hold that property for a year, right? Okay, and so what happens? The stock had a value of $3,600 when he made the donation. Because the property was not held long enough to qualify for long-term capital gain requirement, then Tim would have to do what? Would have to recognize the short-term capital gain of $1,100 if he sold the property, and so they're going to say, okay, well, $3,600 is the fair value minus the $1,100 gain that you would have had to take had you sold the property, which is sort of a long way of coming back to what? His basis in the property, $2,500. Okay, so if it's a short-term item, an item that would produce ordinary income if sold, not one of our capital gain areas. Remember, we had the what assets that are held for a year, the collectibles, all that from chapter 2. If it's not one of those capital gain items, then you're going to have to basically use your basis as a deduction. You cannot use the fair market value. Okay, now you keep going with this, and they say, well, let's say the thing had dropped in value. So it went from 25 down to 23. Well, now he's got to take what? The lower fair market value. So it's the lower of his basis or fair market value. And so in this case, only 2,300 would be allowed if it had dropped. Okay, so they're sort of limiting you there to your basis if it's ordinary income, short-term capital gain type property. Now, a better deal comes to you if we're talking about capital gain property. Okay, if it's capital gain property that we're talking about, and they talk about section 1231 type property, which is basically assets that are used in a trade or business fall under section 1231. But we also had the discussions, as I said in chapter 2, about long-term capital gain property, those that are held for what? Held for longer, a year or longer, then the what? Then the contribution is going to be fair market value. So you can take a deduction for the fair market value of that. So that's a little better deal for our capital gain type donations. Okay, long-term items being the classic one that we'll use as we go through these examples. Okay, so they do have certain exceptions though for our capital gain. Okay, and there are two exceptions, okay, for capital gain property that will limit our ability to deduct that fair market value. Let's take a look at the exceptions. First exception relates to the contribution of tangible property. That's all property that is not real estate and does not include intangible property such as securities, stocks, etc. If it's tangible property and is contributed to a public charity such as a museum, a church, or a university, and the property is put to an unrelated use, then the charitable deduction is limited to the property's basis. So now you go and you give a painting, is what we're going to see as the example in a minute, and you give it to something to help the animals, let's say. Well, you know, how are they going to use a painting to help animals, right? What's going to happen is they're going to sell the painting and then use the proceeds to do whatever it is the not-for-profit does, help animals find a home or something. Well, that's going to be considered an unrelated use, and they're going to limit your deduction to the basis as opposed to the fair value of the capital gain property that's been donated. Okay? Now you come over, and when we talk about unrelated use, that's unrelated to the not-for-profits organization, and I gave the example of a animal shelter type of thing. Here they're talking about giving a painting to what? Artwork to the Red Cross. Well, Red Cross can't really help people affected by disaster, etc. with a painting. You know, hey, stare at this, you know, Van Gogh and you'll feel better kind of thing. They're going to do what? Sell the painting and then go ahead and turn around and use those proceeds. Well, the donation would be limited to the basis. You wouldn't be able to take the fair market value for that. Okay, so knowing this, taxpayers usually contribute a property that will be used in target donations, in other words, now giving artwork to a museum rather than Red Cross. As a result, the deduction will apply. Okay, give a painting to the museum, that's great. Give, I don't know, hospital supplies to the Red Cross, whatever, that will allow that to take the fair market value. As a result, this deduction will apply if the property is not put to, even if it's not put to related use. In other words, the entity turns around and still goes ahead and sells it anyway. In this example, she gives a painting to the local museum that she held for 4 years. Originally, she paid. Okay, where can you get a Picasso for $20,000? Please show me. and I'll go buy it tomorrow. Okay, it's like Picasso for 20,000. Really? I mean, what is it? This big? You know. So anyway, but she gets a Picasso for 20,000, and then she does what? She goes ahead and it has a value of 30,000, and she gives it to the museum, and the museum displays it and then sells it for 50,000. Someone could say, well, that's not the related use if they turn around and sell it. Well, at the time that she gave it, it was reasonable for her to believe that they would have put it to the related use because she gave a painting to a museum, right? And so she could go ahead and take the full 30,000 deduction then. Okay. All right, good. So that's what? One of the exceptions for capital items. We have two. The second exception involves foundations, okay? And if it's a public foundation, fine. But there are certain private foundations that they're going to limit your ability to deduct the fair value of a capital property um, if it is a private entity, okay? And private entities, we can separate them into operating versus non-operating, okay? So if it's a private foundation and it spends substantially all of its time, all of its income in an active conduct of its charitable purpose, then you can still deduct the full fair market value of a capital contribution to them. When I say deduct the full fair market value, notwithstanding some of the limitations that we're going to see, because there's going to be certain percentage limitations of adjusted gross income, but you'll be able to deduct that without worrying about taking the basis. You'll be able to take the fair market value. If it is a non-operating foundation, okay, then they're going to make you use the basis when you give your capital contribution. Okay, so only the private foundation knows its status as operating or non-operating for sure, and the status can be changed from year to year. Okay, but take a look at the next slide. If capital gain properties contributed to a private, and the issue here is what? Non-operating foundation. Okay, we have the non-operating. Okay, so this applies to just the non-operating. The taxpayer must reduce the contribution by the long-term capital gain that would have been recognized if the property had been sold at its fair market value. In other words, that's a long way of saying what? Your basis, right? Okay, so just take a look at this one. 10 years ago, Walter purchased land for $8,000. He held his investment this year, and it is worth $20,000. He donates it to a private non-operating foundation. Walter's contribution, therefore, is what? $8,000. His basis. Why? Because the entity was key word here was what? Non-operating. Okay. If he had given it to a public charity or an operating foundation, then he would have been able to go ahead and take the full fair value. Okay. All right, so let's go ahead and let's take a look at the limitations, okay? Now, right out of the gate, guys, we're just going to put down here, let me change the color, never deduct more than 50% of AGI for charitable contribution. You can never deduct more than 50% of your adjusted gross income for charitable contribution. So every problem you see in the quiz, you know, the thing that we're going to be looking at here, anything you see on your exam, always put that 50% number sort of in your head or to the side or whatever. You cannot deduct more than 50%. Okay? Can't deduct more than 50%. Now, contributions made to public charities, may not exceed 50% of an individual's AGI for the given year. But it's not just public charities, it's everybody, because we're going to see that the non-public, non-operating, operating and non-operating have even lower limitations. So 50% is the maximum that you could ever take. Okay. Now, given this ceiling is quite high, it is rare that individuals will be giving more than the 50% or trying to give more than the 50%, right? That's a lot of your AGI. Okay, so the 50% ceiling on contribution applies to public charities such as 50% ceiling applies to public charities such as schools, churches, hospitals, federal, state, or local government units. Okay, the 50% limitation also applies to private operating foundations and even certain private non-operating foundations. So some can get into that 50% category, both operating and non-operating, but we're going to see that ones that don't get into the category 50%, we're going to have some different limitation categories for them. Okay, and if an entity does not qualify as a 50%er, then it is going to be considered, in the remaining discussion, charitable contributions that do fall into these and qualify for 50% are going to be referred to as 50% organizations. Okay. On the questions on the exam, even in the quiz, you're going to see they're going to call out whether it's a 50% organization, 30%, whatever. They're not going to have you guessing. Okay, is this 50%? Is this 30%? They'll tell you. Okay, so during the year, Tom and Emma contribute $8,000 to their church. Is that a 50% organization? Right out of the gate, we know that's a 50% organization. So they donate $500 also to the Salvation Army. That is a 50% organization as well. And they give a $500 to the Salvation Army and then give some used clothes to the Goodwill, which cost them $1,000 and now has a fair market value of $200. I mean, I think if you wear it once, it's worth $200, right? Okay, so what happens? The clothes are ordinary income, and the charitable contribution deduction is limited to the fair market value, and their AGI for the year is what? 125. So what happens? The 8,000 applies. The 500 is good because it went to the church. The 200 is good. It went to the Salvation Army. And they're what? The total is 8,700. And since they are way under the 50% of AGI, and all of those were 50% organizations, they can deduct the entire amount, right? If they had gone over 50%, then obviously they would not be able to deduct the amounts that are in excess of 50%. Okay? All right, good. Now you come over to 30% ceiling. Okay? And the 30% ceiling applies to contributions of cash and ordinary income property to private non-operating foundations. So now they're putting a limit to what? To what we can deduct for our private non-operating, and it's what? It's cash and ordinary income. Okay, cash and ordinary income. Cash and ordinary income property, so we're not talking about capital. And they tell us that what? If it's a non-operating foundation, in other words, one that hasn't qualified for the 50% category, then they're limited to 30% of AGI. Now, again, they're telling us, hey, there could be some non-operating that in some weird circumstance qualifies as a 50%. Okay, but just as a general rule, you know, I think for this class, if we're seeing the entity as non-operating foundation, it's going to be not a 50% private foundation. It's going to be a not 50%, and we'll have that 50% ceiling. So that's one place that the 50% applies, which is to what? Contributions of cash and ordinary income to what? Non-operating private foundations. They're going to limit you to 30% there. Okay. Now they tell us here that the 30% ceiling. They tell us here that the 30% ceiling also applies. The 30% ceiling also applies to contributions of appreciated capital property to 50% organizations. Okay, so notice that we had what? We had the 50% limitation in that one little example that we looked at, and we looked to make sure they didn't exceed the 50%, and none of the items that were being provided were what? Were capital items. But if you're dealing with capital items that you're going to contribute, then they're going to go ahead and apply that 30% category limitation for capital contributions. So they're going to only let you take 30% of your AGI for that. Okay? And if you are giving both 50% and 30% property in any given year, then you're going to have to limit your contribution you're going to first take your limitations against your 50% property first, and then any amount left over that is not going to exceed the 50 or that would not exceed the 50% would come from the 30%. They do allow you to carry over. Anything that carries over maintains its category as a 30%, 20%, whatever category it is. And we haven't gotten to the 20% yet. But just look at this example. During the year, Lisa makes the following donations to her church: cash of $2,000, unimproved land worth $30,000. Okay. Now she had purchased the land 4 years ago, so it's qualifying for capital gain treatment, isn't it? For $22,000 and held it as an investment. Therefore, it is a capital gain property for the year, and her AGI is $60,000. Now, if you didn't even think about the limitations, let's just see what she would deduct here, and she would have what? She would have the 32,000, which is what? The 30,000 fair value of the land, and of course the cash is just going to be whatever the cash is. There is no difference between the fair market value of cash and the amount of cash that you contribute, so you just use whatever the amount of cash is. But when we apply the percentage limitation, in applying the percentage limitation, the current deduction for the land is limited to $18,000 because we have what? We have a 30% limitation of AGI on that sort of property, and so 30% of 60,000 is $18,000, right? So she can only take 18,000 of that total 18,000 of the total 32,000. Thank you. Because what? Because she's limited to the 30% of the AGI. Okay. Now, of course, the cash is still the cash, and it's not a capital item, and so she can take that. We know that, and then she can take only 18,000 of the 30,000. That makes a total deduction of 20,000, and she's good with that full 20,000 because remember, we always have to bounce that off of what? The 50% of AGI limitation, which she has not exceeded. Her AGI was 60, 50% of that is 30, so she can take the 20, right? Okay, so she took the 2,000. We knew she was going to take that, and then she had to do what? Then she could take 30% of the capital gain property. Now, we'll see that if she had taken already so much from the 50% category, she'd already given so much cash that it was going to cause her to do what? Exceed the 50% of AGI, then she would be limited on what she could take on that 30% of the capital gains property. So there's always that 50% that's looming out there, and you've got to use up your 50% against 50% category first. Then you can start to use up your overall 50% against the 30% property.
So had her cash pushed her over the 50% of the AGI, she would have had to cap it at 50 or take the lower?
Yeah, let's say she gave what, 32,000 cash. She's done. She's not going to take anything for the capital gain because they apply it all against the 50% category first. Now, that doesn't mean that she can't carry it forward. She can, but in this year, she wouldn't be able to take any of that because she gave cash that's in excess of 50% of her AGI, which I don't know why somebody would do that, but if that's what they wanted, they got, congratulations. May you find yourself in that situation someday where you're giving away cash that's in excess of your adjusted gross income for any year. So we first use up the 50%, and if we still have some left over, then we go to the other categories. Okay? Okay, good. And then once you get past that 50%, you stop, but you can carry them forward. Okay? Now that's the 30% category. We also have, thanks IRS, thanks Congress or whoever the hell thought of all this, okay? But we still have what? We still have a 20% limitation category. Okay, now what happens here? 20% ceiling applies to capital gain property to private non-operating foundations, those that are not 30%. So all they're doing here is what? Squeezing the ceiling even tighter for capital gain contributions instead of it being limited to 30% like it is for the public entities and the private operating foundations. Non-operating, they're going to squeeze them even tighter on the capital contribution and say you can only take 20% of that. So if you kick in to a different type of organization, they'll limit you to the 20%. Okay? Now, once we have, used up the amount of contribution that we could take, either because we've hit the 30% ceiling or because we have hit the 50% ceiling, whatever stops us from taking the full amount that we could have taken, we can carry those over for the next 5 years. Okay, and as they carry over as whatever category they were. So 30% stays as 30%, 20% stays as 20%, etc. Carry over, that's not yay, that's year. Okay. Okay. All right. So let's go ahead then and just look at this example, which is somewhat helpful, I think. Okay. Taxpayer AGIs 100,000, contributed 40,000 of cash and long-term stocks with a fair market value of 35 and a basis of 8 to a university. He can use the fair value because it's to a public entity. Okay, so he's going to use the fair value, but he has a limitation as to what? 50% of his AGI is the most that he can give. His AGI was 100,000, so he's got the 50,000 limit coming up. And so what happens? The 40,000 cash first goes against the 50,000 limit that he has, right? So now he's got 10,000 left. The 10,000 now will come from the 30% category, and what? Well, he can't take the full 30,000 because he's only got 10,000 left to give. Okay, so he gave 10,000. That's 10,000 of fair value, and so since the property the stock had a fair value of 35,000, then he still has what? He still has 25,000 left to go, which he carries forward, and it carries forward being held still as what? Being considered still what? 30% property. Okay. So that's a pretty good example, I think, showing how you would apply the thresholds going against the 50% first. Okay. All right. Good. Let's look at a couple of questions. Okay, I didn't think I had put these into the slides, but I guess I did. Okay, but let's go ahead and let's take a look at a couple of questions dealing with the capital contributions. And by the way, guys, these questions are still in the Word file as well, same questions. Okay, so I think it's worth your time to sit there and reconcile and make sure that you got all the questions, because there may be some in the Word file that I, for whatever reason, didn't get into the slides themselves. So you may find a couple of nuggets in the Word file itself that weren't in the slides themselves. Okay. So let's just go ahead though and let's take a look. Byron owned stock in Blossom Corporation that he had donated to a museum, a qualified charitable organization, on June 8th this year. What is the amount that Byron's deduction, assuming that he had purchased the stock for 10,500 last year on August 7th? Now, back up for a second, because you see stock to a museum. Shouldn't you give stock to a stock trading company? There are no charitable ones. What happens? It's what? Tangible property that we have to worry about the unrelated use, right? This is not tangible property. This is stock. So the unrelated use is obviously, and you can never give stock to anybody, not for profit. They had applied that rule to things other, things other than tangible property. So what happens? What is the amount of the deduction, assuming that he had purchased the stock for 10,500 last year on August 7th? Well, my first question to Byron is, what the hell are you doing? If you had waited, what, one more month or so, it would have qualified as long term and he could have taken fair market value, right? So, a little tax planning here. Dude, wait another month. What are you doing? Okay. But what happens? He goes ahead and he donates it too quick. And so he has to use what? Can he use the fair value or does he use his basis? Has to use the basis, and we're going to yell at him as his tax accountant and tell him, why did you do that, right? Okay. Okay, good. Let's go ahead and let's take a look at this next one. And we've got Zeke. Okay. And Zeke made the following donations to qualified charitable organizations. Okay. We've got used clothing. Okay, that he acquired more than a year ago. And so we're going to pick up what? Fair value on that. It doesn't matter that it was more than a year ago. It was ordinary income. Okay, you couldn't generate any capital gain off of clothing. So it's going to be what? And then the fair value is less than his basis, so it's going to be the fair value, right? Okay. Then what? Stock in ABC company held as an investment for 15 months, and you look at that and you say, well, gee, the basis is more than the fair value, so too bad that he has to deduct what? The fair value, right? He held it for more than 15 months. He'll have to use the fair value. If the property is not appreciated, it doesn't even matter that he held it for 15 months. If we don't have appreciable property, then we automatically go to the fair value, right? If it's come down. Okay. Stock in M&O held as an investment for 11 months, and he's got fair value of 18, and he's got what? Basis of 15. What does he have to take? Got to take basis because he didn't hold it for the full 12 months. Again, I don't know who these people are. Okay, hold it for one more month, dude. Okay, and then what? Real estate held as an investment for 2 years. Yeah, he can go ahead and do what? Pick up the fair value on that one, right? Because he held it long enough. Okay, so you go ahead and you add those up. We have the what? We have the closed fair value of that stock that he held for 15 months. And it's not so much that he held it for 15 months as much as if it's non-appreciable property. I guess that does kick you to fair value. But if it's a lower fair value, then you got to take that lower fair value regardless, right? And then the 15,000 for the basis because he didn't hold it long enough. And then finally he got smart and was able to donate something that had a longer holding period, and so he could take the fair value. Okay, so what's that come out to? 56,250. Okay. All right, good. Let's look at this one. I think this one's going to be a real good example of how the 50% cap gets applied to our different categories. So he has cash donated to State University and tell me that fair value is 30. You think? Do you think the fair value of cash is whatever your basis was in the cash? Okay, so it's 30,000. So cash will always, be treated as a 50% category because it's not appreciable property in any way, shape, or form, right? So you're not going to have any capital gain on cash. So that's a 30,000. Then unimproved land that he gives to the city of Terre Haute, Indiana, and it has a fair value of what? Fair value of 210 and a basis of 70. And we're thinking that what? He should be able to go ahead and take that fair value on that unimproved land. Okay, let's see. Huh? Oh, it's Karen? Why am I saying he? Did they change the guy on me in the middle of this? No, this, I guess the last one was a guy. This is Karen. Okay, sorry, Karen. Okay, so the land had been held as investment and was acquired 4 years ago. Okay, so we know that the land is meeting the long-term requirement. Shortly after the receipt, the city sold the land for 210,000. That's not Karen's problem. There was no reason for her to think that land to a city was an unrelated use, right? Okay, so even though they sold it later, that's fine. Karen's AGI, and land does not qualify as tangible property anyway, right? So 450,000 is her AGI. So the allowable contribution is going to be what? And she can only take the 30% of her AGI for the value of the land. 30% is what? 165, right? So she can take the 30,000 cash plus what? Just 30% of her um, of her AGI. The 135 is all she's limited to because she's limited to what? 30% of her AGI. She's limited to the 165. Okay, and so the capital gain property is limited to 30% of AGI or 135,000. So that's all she can take there. Now there's a carryover, which is what? The fair value of the land minus what she was allowed to deduct. So she can carry forward what? 75,000, and that will maintain its categorization as 30% property going forward. Okay, so she could take the cash. She was fine there, but she was limited to what? 30% of her AGI, the 135 on that capital gain property. So that's how they came up with 165, and she can carry the rest forward. Okay. Okay, good. Now I'm looking for Ralph. Here's Ralph. Okay, so now we've got Ralph. Okay, and he made these donations of cash, 63,000, stock of 94.5. Okay, and he made the investment in the stock 14 months ago at a cost of 42,000. So he can use the 94.5, right? But what's going to happen? The 94.5, and you can kind of see this coming, plus the 63 is going to put him over his 50% of AGI. So the guy makes 189,000. If he makes 189,000, then what's going to happen? 189,000. Let's just go ahead and write this here. 189,000 times what? 0.50 gives him how much? 94.5. Okay, this is how I would calculate it. 94.5. And then I'm going to go ahead and I'm going to take the cash off of there, right? Because you have to first use up the 50% category. So that leaves him 94,500 minus 63. Help me out, guys. I didn't figure this out before class. Huh? 31,500? Okay, so he's got 31,500 that he can take off the what? Off of as a deduction off of the value of this stock, right? Okay, so he's limited to that 31.5 that he can take for that. So his total deduction ends up being the 63 cash and the portion of what? The portion that he still had before he used up his 50% cap. And once he added that in, he used up his 50% cap, didn't he? Okay. Now, is there any more that he has to carry forward? Got a 50% cap, right? You got to first go against your 50% property. He gave cash. That's 50% property, right? His 50% of his AGA is 94.5. He what? Can't take more than that. So he's taken 63 from the 50% category first. Then he goes to the 30% category, and he can go ahead and take up to an amount that will keep him up under or at the 50% cap, right? But he can still carry forward the rest of that, which is what? Which is going to be the remaining amount of that property. I'm trying to see if they give it to me here in the solution. Huh? 63,000, which is what? When the contributions for the tax year involve both 50% property and 30% property, he can deduct the balance. But this solution is a little hard to figure out what's going on here. So he still has what? He had 94.5, and he's limited to what? 30% that he can take on that. So 94.5 times 30% is going to give him what? I'm sorry, not 30%, but he already took what? He already took 31.5? Okay. He already took 31.5. So he's got what? That's where they're coming up with the 63,000 that he has left, and he can carry that forward, right? But again, it maintains its identity as 30% property. So he can't take any more than 30% in any one year of that amount that carries forward. He can continue to carry 30% of his what? Of his AGI, and it maintains its identity as 30% property as he goes forward, right? Okay. Okay, guys, are we done for today? We can go? Or you want to keep going here? Okay, okay, good. So I'm kind of feeling a little bit at this point like I'm talking to the wall. Okay, but if that's the case, just let me go home, or let me get on the bridge so I can go to my next class. That's where I really would go. So we're good, or we want to keep going? Okay. All right. So let's take a look at these miscellaneous deductions. Okay, miscellaneous deductions for things like professional dues, uniforms. You can only take those to the extent that they exceed 2% of AGI. Okay. Now, you take a look at the miscellaneous category a little bit on the next slide. And when we take a look at the next slide, there are some items that are not limited to the 2% of AGI floor. Okay, so when we have gambling losses, we are allowed to deduct those, but the limitation there is not 2% of AGI. The limitation there is the extent of your gambling winnings. Okay, so that's one that is not subject to the 2% limitation. And I'm not going to read all of these impairment-related work expenses of a disabled individual. You're not limited to the 2% floor for those. So some are not limited to 2%. They still fall in the category of miscellaneous. Then you come over, and they do have an itemized deduction phase out. Okay, and this is one of the areas where they do sort of take a little bit out of the hide of higher income individuals. So they tell us that if a taxpayer has, and we are limited to the lesser of 3% of the amount by which AGI exceeds 313,800, or 80% of the itemized deductions that are affected by the limit and are affected by some limit, like the 2% limit. But we're going to see that some items that are affected by limits, they will not make us consider that as part of this 80% calculation. Okay, so the overall limitation is applied after you've considered all other limitations to those itemized deductions that are affected by overall limitations. For example, other limitations apply to charitable contributions, meals and entertainment expense, certain other miscellaneous items. Okay, so the best way to understand this phase out is to look at this person who's a single individual making 275. Notice up here, you say, well, I thought it was 313,800, but for single individuals, it's 261. So he has all of these itemized deductions, his medical expenses, his state and local taxes, real estate taxes, interest on his home, charitable contribution, casualty loss of 29,000, unreimbursed employee expenses that have the 2% of AGI limitation, gambling losses, of which he had winnings of what? 3,000. So he's going to be limited to those winnings there of the 3,000. Okay, we know that. Okay, so let's just go ahead and let's take a look at how they are going to categorize these. And the limitation of what you're able to take applies, and it applies to what? Taxes, home interest, etc., right? But certain itemized deduction they don't make you apply the phase out to. For example, medical expenses, investment expenses, wagering losses, and again, that's up to your winnings, and what? Casualty theft loss. So they've sort of put some things off to the side. And it makes sense that if they're letting you take a deduction up to your winnings, it doesn't seem very fair to, make you pay the tax on the winning and not let you take the deduction and limit the deduction somehow. Medical expenses. If you're that sick and you're having to incur all those medical expenses, we're not going to limit your itemized deductions based on that. Okay? So you come over and they give us the thresholds. I do not expect you to memorize thresholds for the exam. I will make it clear what the thresholds are and any questions that I give you for the exam. Okay, but let's just go ahead and let's take a look. And we have the limitation, 3% of the amount that exceed the thresholds or 80% of the itemized deductions that are affected by the limit. So again, this guy has all these things. I'm not going to read these off again. And you come over and you start to take a look at how they calculate that. So he has what? He has his medical expenses, etc. He has total itemized deductions of 22,000. But because his income is getting up there, we got to see if he's going to have a limitation on what they'll let him take. So he first has to gather those itemized deductions that are subject to the limitation calculation, state and local taxes, real estate, etc. And we add all of those up, okay? And he has 15.5, okay? Now, he has to what? He must reduce his itemized deductions by the lesser of either the 3% that he is over the threshold. Threshold was what? 261 for 500 for a single individual. He was making what? 275, right? I mean, he was making where did it tell us he's making 275? There it is. He was making 275. Okay, so he's making 275, so he's a little over that threshold. 3% of that is 405, or 80% of the deductions limited that are subject to the limitation. Okay, so we take the 15.5, all of those were subject to limitation, multiply that by 80%. That number is the bigger number. We're going to pick up what? The lesser number, the 405. So when we consider his itemized deductions, we take what? The 15.5 of all those that were subject to the limitation minus the amount that's in excess of 3% of the threshold. So he can take what? Of those subject to limitation, he can take 15,095, and then these certain category ones, the medical expenses, etc., are not subject to any limitation, so we have to add those back in, right? And he can take those, 100% of whatever is allowed. Medical expenses, the casualty loss, the gambling losses, up to his winnings. Notice he only took 3,000, right? So the limitation is only applied to certain items there, and additional amounts he can go ahead and take those in total. He doesn't have to limit those at all. Okay. All right. Question on that? Okay. Let's take a look. I think that's the end of the slides, right? No, okay, I got the questions. So I guess I got more questions in here than I thought. So let's take a look at this one. Which of the following items would be an itemized deduction on Schedule A for 1040 that are subject to the 2% floor? And we have what? Professional dues paid by an accountant employed by Ford to the National Association of Accountants. That is what? That is dues. That is not limited, right? That's not an amount that's limited. Gambling losses to the extent of gambling winnings. That is what? That is going to be subject to the 2%. Is not subject. Excuse me. Okay. I was trying to figure out what the hell is going on here. Is not subject, right? So that one is not subject to the 2% floor. They'll let you take up to what? Your gambling losses. These others, job hunting costs, appraisal fees for valuation, expert to determine the fair value of work donated to a qualified museum, these are going to be things that would be subject to the 2% floor. Okay. Number 15, Paul, calendar year taxpayer, files a joint return for 2017. Information is as follows, and Paul's allowable itemized deductions are what? So he's going to go ahead and pick up the state income tax of 13.5 or the sales tax. Income tax because it is higher, right? Real estate taxes, you can take those. Gambling losses, gambling winnings were 12,000. So he can take what? Gambling losses, and you can take the whole amount since he had winnings that were in excess, right? You can take up to your winnings and losses. So he has 68. So he's going to take what? He's going to take the 13.5, the 18.9, and the 6.80. So his total itemized deductions of 39.2. Okay. Okay. I think those are all of them. Yeah. All right. So talk to me, guys. Are we doing this thing tomorrow or not? Yes? No? Okay. All right. So what I'll do is I will record it here. Okay, and I will go ahead and post it on B courses if you decide that you don't want to come to the class for it, or if you don't want to watch it at all, you don't have to. And then the test will be what? The test will be on Tuesday, and I'm going to start to bust into the room right at 2 o'clock. So 12:30. I'm going to start to bust in the room right at 12:30 so that we can try to motivate the preceding class to get out, and then we'll hang on as long as we can to 12:30, right? But that means, 2 o'clock. But that means that I highly recommend you be on time, right? Otherwise, you're going to cut yourself short of your time to take the test, okay? Scantron, skinny green Scantron, the same one that we used last time. Okay, 15 multiple choice questions, 1 free response. Okay? All right, guys. I will either see you tomorrow or I'll see you on Tuesday. Good luck, guys. Hey, how you doing? I would say probably if I had to put